Bull markets are very hard, right? Because the stuff which goes up and you just cannot understand it.
Hello everyone to another episode of our show. My guest today is Chirag Setalvad, Fund Manager and Head of Equities at HDFC AMC Limited. Chirag, welcome to the show. Thank you so much for doing this for our audience.
Thank you very much for having me on board.
It's great to have you, Chirag. Let's start at the origin story.
Sure.
I believe that you did your graduation from University of North Carolina.
That's right.
What brought you back to India in the markets?
Well, the markets didn't bring me back, but when I graduated all the way back in 1996, there was a lot of excitement about India at that point of time, and a lot of ADRs and GDRs getting launched, and market was in a tear and so on. And I think that was one excitement. But to be honest, I'm a Bombay born and bred boy, and like any other good Indian child, I miss my family and miss my city, and that drove me back. I think the fact that India was booming and so on, at least I knew there was some opportunities, but I don't think I was so savvy to think that that was the reason to come back. It was much more a personal decision than any kind of professional decision.
First job I believe was ING Bearings.
First job ever, yes.
What was that? I mean, which field did you get into there?
So I joined in investment banking. I didn't know much about what investment banking entailed. I just knew it was a glamorous job and guys wore suits and looked good and made a lot of money. That was enough at that young age. And I joined ING. I was there for several years. I didn't really enjoy it that much. It's much more of a fundraising type of business. I was also very, very junior. I was an intern for a while. I was surrounded by some very, very smart people. But the job itself was, I wasn't doing much, to be honest. As you would imagine, somebody who's just starting out their career, I didn't do much. But I think the interesting part was ING Bearings at that time, we also had a broking business. And we also had, for that matter, a FI business. And the broking business at that time was stacked with people of incredible caliber, right? You don't get those kind of individuals in one organization anymore. And there were star analysts in cement, star analysts in auto, star analysts in IT. All of those guys were fantastic analysts. Yeah. And while I spent most of my time doing not much, I also got to interact with a lot of these guys who were incredibly smart and sharp. So that was one big benefit. And the other is when you don't have much time, it gives you an opportunity to explore other interests. And I had a fair amount of free time because I was an intern. And they had a Reuters machine at that point. And my family always had investments in the stock market. So there was always, I wouldn't say dinner table conversation, but at least it was there in the background. I knew it was relevant. The fact that Reuters was there, the fact that I had free time, the fact that we had a library, and then we had these smart people who I could overhear. It was a good, in its own way, a good start.
Yeah. So these were preparing pitch books and.
I was very down the totem pole, so I did a lot of the grunt work, some of the grunt work at least. Yeah. So it wasn't very value added.
Across sectors.
Across sectors.
But you kind of knew that you wanted to be here, at least in the capital market. Maybe not in investment banking.
I don't think people starting their career are so. Very few young people are so convinced that, this is what I want to do, right? There are those who want to be doctors and lawyers and so on. But otherwise, very often the career finds you. You don't find the career. I had a broad interest, but it wasn't that I had to be in equity markets and this was my drive and my passion and so on. In college, I read a few books on investing and I was interested in the subject. Sure. Like many other students, I wrote a letter to Warren Buffett and so on.
Oh, nice.
Which never got a response to.
Never took the trip to Omaha?
Never took a trip to Omaha, and by the time I was able and capable, I had lost a little bit of interest in doing so.
From there to HDFC?
From there, I left and joined HDFC. I was very fortunate. I was fairly naive as far as stocks go, still somewhat naive. But it was, I was very fortunate because, it's a big brand. Yep. At that time, we were the 25th AMC to launch. So we had 0 assets under management. I entered the office and there were big boxes of Fevicol lying around, and it was a makeshift cabin where I was interviewed. So it was, but the opportunity was was large because it was HDFC. And in that sense, I was very fortunate that they gave me a chance when they didn't need to. because I didn't have the experience, I didn't have the smart answers, I didn't have any of that. But Sanjay took a chance on me, and I not only took a chance, but I think, like most young people, you get these jobs through some connect, and I did have some personal connect with Sanjay, and he realized at least this guy's not a, at least I wasn't a buffoon. I wasn't smart certainly, but I wasn't a buffoon. So he said, if he's not a buffoon, and if he can't really mess it up, then maybe I can help him along the way.
Yeah. So for our audience out there, Sanjay, that Chirag is referring to is of course Sanjay Bhattacharya. This was the original founding team of HDFC AMC.
That's right.
Which had Sanjay, which had Prashant, which had a lot of people who are now veterans.
Well, Prashant wasn't a founding member of HDFC. Of Zurich he was certainly.
He came in during
but
the
he came
Zurich
fairly soon after that.
Yeah. What next? Then I think that you went with Sanjay to New Vernon.
So I was there from 2000 to 2004, and then I left in 2004. I joined New Vernon. I was there for 3 years. New Vernon was a US-based, India-dedicated hedge fund, which at its peak got to a couple of $1 billion, run by some very smart Wall Street individuals. And that was a 3-year experience. And then I left and then rejoined HDFC when Prashant was there, and he gave me an opportunity to come back, which was fantastic.
Yeah.
And I've been there since.
Yeah. So that's 17 years and counting, 18 years probably.
Yeah. So it's been 25 years, but with a little bit of a gap here and there.
Yeah. What is it like to work with Sanjay both at HDFC and then at New Vernon?
So Sanjay, for those who know him, he's obviously incredibly smart, incredibly well-read, incredibly colorful, and incredibly generous in his opinions and his views. And I was fortunate because I was a blank canvas. I think that's the advantage that young people have. You sometimes don't have any preconceived biases. I didn't certainly have any. And he has a great bottom-up approach, fundamentally driven, stock-specific, all of that stuff, long-term in orientation. So all the first principles of investing that you would like, buy during tough times, all that stuff, which is easy to say but difficult to imbibe, because very often you come across these later on in your investment career. But when you're a blank canvas and you get introduced to these things, you feel that that's the only way. What other way is there? And he introduced me to books. He sat with me on annual reports, reconciling income statements and balance sheets with cash flows, and so it was. I certainly learned a hell of a lot from him. And as I sometimes warn him, he gets credit for my successes, but he also gets credit for my failures. A lot of the credit goes to him.
We'll get into the failures in a bit, but 2003 to 2007, or even 8 for that matter, when you had that incredible bull run in India, it was a global run before the global financial crisis happened. India, I think, was seeing this entire boom in domestic cyclicals, real estate, infra, electricity, like across the board. What is it like at that point of time for you to be looking at sectors to invest, outlook at investing, early philosophies at that point of time?
Actually, I don't think things change that much, right? I think the fundamental difference obviously is that a bull market is hard to invest in because everything is running, a lot of it is narrative based, and quality doesn't stand out anymore, and management quality doesn't matter anymore, and all of that stuff. So bull markets are always harder to keep up with, and I've always underperformed raging bull markets. Correspondingly, we typically outperform terrible bear markets, and in markets which are somewhere in the middle, we hope to outperform 50, 60, or 60, 70% of the time. So if you put that all together, you come out with reasonable performance. So I'm a little bit odd in that sense. You do learn from history, but I don't look back in terms of what was this period and what. I mean, you've learned a lot. I've learned a lot from markets over the years, obviously, as everybody else has. But I think bull markets are just difficult. You really, it tests your patience, and because your thesis goes wrong so often. That the temptation to do something which everybody else is doing, which is much more momentum, is there, and you have to resist that. So bull markets are tough, but I think this is a little bit like Groundhog Day. You start every year afresh, right? Don't look back at last year, whether it was a good year, bad year, bull year, bear year. You have to find the best stocks that you can right now, right? And obviously with a 5 and 10 year horizon, but in that sense you restart. So every year is forgotten.
I think what mattered, what probably made the 2007 bull run different, at least as far as India was concerned, was that you had a very long bear market prior to that, 93 to 2003, when the Sensex Nifty went nowhere, and a very interesting time, as you would know, because bond yields had halved, equities were trading at some ridiculous numbers post 9/11 and just early 2003, where I think dividend yields in some cases were more than what FDs were offering.
Yeah.
You couldn't get a more, we probably just needed liquidity to come in to spark that off. Any, memories of that,
I don't think, at least in my case, I don't think I operate differently how does it matter whether it's a bull market or bear market, right? You have to still tick mark all the boxes you would like to, right? You want to buy into businesses that you can understand. You want to buy into managements which are, honest and competent. You want to buy into businesses with decent ROEs, decent cash flows, and sensible relative valuations. So the part which changes is the relative valuation bit. In a bull market, everything's expensive, and your stuff is also expensive. It's just a little bit less expensive than everybody else, or at least you aim to do that. And the hunting is far harder. In a bear market, the hunting is far easier, right? Because there are opportunities galore. So I think that's the big difference. But otherwise, we've seen plenty of bull markets, plenty of bubbles, stupidity in IT, stupidity in utilities, stupidity in PSUs, banks. So every once in a while, either the market as a whole or sub-segments behave irrationally, and you want to stay out of that, right? And you hopefully do, to either entirely or to a great extent. But I don't think we change. If you told me that the next 1 year is going to be a bull market, and you assured me of that, it's not that we're going to search out beta, right? And search out high risk and search out narratives and so on, or vice versa. If it's going to be a bear market, let's get into FMCG and defensives and so on. No, we are stock specific, right? And we have to. There will be some pull here and pull there because certain industries and segments do better in different environments. But that's still a bottom-up approach to the business as opposed to a top-down, macro-driven, thematic-based approach.
And you believe that in your career so far that India is a bottom-up market and you need to get that right? Tailwind the top-down will always be there? Anything about that?
I think this top-down, bottom-up, it's a little bit odd because nobody does only one, right? But I suspect there are those everybody does a little bit of both. But there are those who are a little bit more bottom-up and there are those who are talented enough to do bottom-up and top-down. And I say talented enough because the top-down is a little bit harder in my mind. I think when you get granular and specific, it's a little bit easier. When you get broader, it becomes a little bit more challenging. But I've preferred the bottom-up approach. It resonates with me. It's a style which, like I said, I learned under Sanjay, and as a result, it's an approach I prefer. I think what we're getting wrong in this market, or this environment, not market, is that we belittle other people's style. So the bottom-up guy says the macro guy is following the wrong approach. The small cap guy says the mid cap is following the wrong approach. The large AUM fund says the small AUM fund, the other way, small AUM fund says the large AUM fund is at a disadvantage. The value guy says the growth guy is at a disadvantage, and so on. Concentrated guy says the diversified guy is at a disadvantage, and vice versa. And I think you've got to follow your style, right? It's different strokes for different folks, and you shouldn't badmouth anybody's style. But bottom-up works for a lot of people. It certainly works better for me because it suits me.
Yeah, it's funny that you mentioned about how in the bear market the opportunities are more, in bull market the opportunities are less. Ironically, the flows are the other way around.
Yeah.
When you're looking, when you know that the market is appealing, attractive, the flows are in there. And when you know that probably the best is over, the flows really come in.
Yep.
And it becomes that much more difficult to then keep on, delivering beta after beta after beta. How has that, turned out for you so far?
I'm not sure, is it really that much harder? Because we are relative return investors. So you give money at the top of a bull market, I'm giving you a relative return. Market falls by 25% and I'm down by 18%. I've done a great job. I'm not here, none of us are here, most of us are not here to give absolute returns. We're here to give relative returns. So actually in the top of a bull market is probably, it's easier to invest in because markets are likely to correct from there. Correcting market is far easier to beat.
Buy into.
As opposed to, it's just an easier market to beat because the stuff, the poor quality and governance ones and the narrative stuff, all that tends to underperform. So yes, the money flows in, obviously on the way up, not right at the peak. On the way up, it is more challenging. The ideas are not there, so you do the best that you can. So it's not that it's not more challenging. It is a little bit more challenging for sure. But then I think you've got to take solace in the fact that we are in a relative business, not in an absolute business. So you try and find the best opportunities. And the difficulty is that sometimes you don't have full conviction in eking out a absolute return. And you feel, I may not do so well in this, but everything else is going to do far worse. And you got to go ahead with that investment. And that sometimes is counterintuitive. But there's only so much cash you can hold in your portfolio.
You think this is the Chirag Setalvad of 10 years ago would have said this, and 20 years prior would have said this?
Chirag Setalvad of 20 years ago was, was certainly had no idea. Now I have some idea. After doing something for 20 years, we all become experts. So that's inevitable. But you learn. Everybody learns, right? We all, the same would apply for you in your career as well. And we are all smarter than what we were 10 years ago, because, or at least we appear to be smarter, because we've got more sort of white hair and years behind us. So yeah, you do learn from that. You learn a lot, especially in markets over a period of time.
Yeah. Let's move to when you joined HDFC back in 2007.
Yeah.
Yeah. This was a time when I think the mid cap scheme came first, and then the small cap scheme.
Yeah.
Mid cap I think was in April 2007, and small cap was in June 2008. What a time to invest, right? Because you got April 2007, which is probably the start of the melt up, and June 2008 was the beginning of the melt down. Remember how that was like?
So when we first launched, we raised a small corpus. I mean, not that small in those days. We launched with, I think, 1700 crores, which was a fairly large amount of money at that point of time. And it was challenging, right? Because we invested in the market, we raised in the market, ran up very, very quickly. And when you have a lot of cash to begin with, then it becomes a little bit harder. If you're already fully invested, then you live with the markets. So we underperformed materially in year one. And unfortunately, your first year does impact your long-term CAGR a lot. Yeah. So actually, we've never done this exercise, but had we taken out the first year, our returns compared to benchmark would have been far better.
Oh, okay.
But that was a handicap that, that's reality. So we can't make excuses, and we can't, do a performance analysis in that fashion. It would be totally dishonest. But it was certainly hard when the market is running, you've got cash, and then you underperform by 15-20% just because of cash. Yeah. And then you get to that fully invested level and the market corrects, and then you don't get that cash disadvantage has gone for a long time. Yeah. And then you just got to build up through alpha, which is not easy.
What happened in June 2008? I think the collapse had just begun, or I think that ended in 2009 if I remember correctly, March 2009. 8 to 9 was also pretty rough and rocky. You had a volatile market at that point of time. So I think the small cap scheme launched in June 2008.
So small cap scheme was not launched per se. We acquired Morgan Stanley
okay.
As an organization, and we took over the Morgan Stanley all cap fund, the ACE fund, and then we rechristened it the small as a HDFC small cap. But honestly, there was not that much. The expectations were very low. Small cap wasn't some sexy category. There was no major expectations. If I remember, AUM was 250, 350 crores. So it wasn't that Morgan Stanley was certainly not acquired for ACE. It was acquired for many other reasons, including other funds. So the expectations was low. The pressure was low. Now, of course, small cap, there is a lot of interest and excitement, and hence visibility and so on. So it's okay. I think my view is you have to try and do the best that you can, right? Pressure, no pressure, bull market, bear market. You put your hand on your heart, you can go home and sleep well, right? And if you don't, you'll never sleep well.
Any memories from the early days of fund management, like? So you landed up in a pretty rough spot, at least with the markets at that point in time, or?
No, I don't. My memories are not of the market. It's more about the individuals that I worked with, right? Working with Milind, who was obviously a fantastic person to work under as a CEO, Sanjay as a CIO, who taught us so much. He was such a larger-than-life figure and so open and generous in his views. Guys from sales. I was very, very young, so everybody was incredibly smart around me. So there was so much to learn, right? Vijay Mantri, who looked after our sales, was incredibly sharp. So we had, Rajiv Shastri, who looked after fixed income. There was a 5,000 crore fund in those days. So all incredibly smart individuals to learn from. So my memory was much more of being intimidated by such erudite individuals, and I genuinely mean it. And a lot of them are very kind to me.
Do you have people who say the same about you now when they join in?
I hope so. I think the big difference is they're not as dumb as when I joined, genuinely. Okay. I mean, the guys we're hiring are people with 10, 15 years experience, right? We're hiring people and I'm learning from them immediately. people hired me and nobody learned from me for a long time.
Prashant Jain, what was it like working with him?
Oh, great experience. Sanjay was a great individual investor, of course, in institutional capacity as well, and Prashant was a fantastic institutional investor, and he covered it all, right? He had incredible intellect. He was, I think, the hardest working individual I have come across in markets and outside. So you've got a combination of intelligence and rigor, and you combine that with risk management, and that's a lethal combination. And that's why he's done as well as he has in all capacities, because you don't get that too often. He had the character as well. So you have character, intelligence, hard work. That's not easy. Usually you get 2 out of 3 or 1 out of 3, but he had 3 out of 3.
You learned a lot from him, I'm sure.
Yeah, absolutely.
Yeah,
without a doubt.
So 2008 to 2018, if you look at that 10-year period, not exactly great. If you look at even for benchmark indices, you barely got maybe a few percentage points at or above FD rates, right? And then you've got small and mid caps, which in your case, from what I can see from the fact sheets, year after year after year were just outperforming throughout, right? At least post 2012, like you said, the first few years might have been a little bit tough, the first year. But after that, you just had this incredible run. Despite markets going nowhere, you still had the performance coming with you, right? So what was that like?
No, I don't think that's the right statistic. We've had good years and bad years in small cap for sure. I remember plenty of times when people have turned around and said, what is your small cap fund doing and why are you guys underperforming so much? And not just once, we've had it several times. So I don't think it's been smooth sailing. I don't think it should be smooth sailing. We'd be lucky if that were the case. So in small cap, we've had plenty of ups, plenty of downs. Fortunately, our ups have been higher than the downs, and as a result, the CAGR looks great. But if you look at it on a financial year basis or on a calendar year basis, certainly 35% of the times we've underperformed. So 3.5 out of 10 years, we would have underperformed. Mid cap has done a little bit, I think, better than that. So again, we've had tough times. For sure. It's not that it's not been smooth sailing, and I don't think it's smooth sailing for anybody, right? You have to be a remarkably smart and lucky person, and I think that combination is really hard to find.
Let's get into the reasons for the underperformance, whichever years that they would have been, 35% of the time. Looking back now, obviously, what would you have attributed to? I know that 2018 was one of the years, but then 2018 was bad for the entire markets. You had a crisis in the NBFC sector. You had a lot of things happening at that point of time, and even prior to that, a couple of years were rough, right? So there's one, obviously, that you've got the sector not doing well, the market's not doing well, so you are bound to underperform at that point of time, or at least not do well. Anything other than that you can recall, reasons, process, philosophy, anything else?
I'm not a person to look back in time. I think you learn a lot along the way. So it's, regardless, you have to recognize that history is a great teacher, right? But it's not only history of your performance, it's history of the performance of everybody, and there's so much knowledge out there on equity markets. But for me, it's always been that bull markets are very hard, right? Because the stuff which goes up and you just cannot understand it, right? And a lot of these stocks become meaningful part of competition portfolios and benchmarks and so on, and is very frustrating, right? Because you just can't figure it out. You feel it is unjustifiable and keeps going north. And you just got to be patient, and eventually things do tend to work out. Not every single time, but by and large they do. So my memory is really much more about bull markets being very challenging when individual stocks have just gone absolutely crazy with zero fundamentals or low fundamentals, and you scratch your head wondering what are people seeing. But eventually, at some point things have to come back to reality.
How do you navigate those times when you can make out that that quality is going for a toss, anything and everything is just going up, and you're probably collateral damage of that?
Like I said, your hand is on your heart, right? Are you working hard? Are you doing the best thing? Are you not changing your style? If you can answer yes to all of that, if you can invest in the portfolio like you would invest your mother's money, you're fine. And we by and large followed that approach.
What are the lessons you learned in 2018 say different from what you learned in 2008? Other than the fact that in bull markets everything goes up and you're going to be left behind, but or is it the same thing?
I don't think it's bull market lessons or bear market lessons. I think lessons happen over a period of time, right? So I think the biggest lesson that everybody has learned, including us, I suppose, has been that investing in quality pays off, right? And when we talk about CAGR and long-term investing, and good businesses and good managements keep delivering a higher incremental growth and incremental profitability than everybody else.
Sure.
And that has been the number of misses we've had because we found things a little bit expensive, or in some cases quite a bit more expensive than we would like. But the business was just of great quality, or the management was of great quality. And I hate to refer to Buffett because it's so cliched, but Buffett moved in that direction clearly, and a lot of investors in India have also gravitated in that direction. Some to a greater extent, some more incrementally. But certainly, that's the biggest lesson. One of the biggest lessons, which is that to pay up for really good quality businesses tends to be rewarding. That doesn't mean you get carried away, but it's okay to pay up a little bit.
Sure.
And correspondingly, getting cheap businesses, getting poor quality businesses or really mediocre businesses at cheap prices is not a great recipe. I mean, it can work out, but it can be the wrong recipe.
The chances of paying slightly higher for something that is going to work out, the chances are much higher there of making money versus something that you're buying at a mediocre price that is
absolutely
not going to work out.
And we've lost out on 10 baggers and 50 baggers and 500 baggers, and on the other side you can only lose 100%, right? That's it.
Wow. How do you live with that? Or that's just part of the job?
What are you going to do? I mean, if you have to keep analyzing on that basis, you won't sleep ever.
Yeah. Is the small and mid cap category fundamentally different from large cap, or are the rules the same, only the market cap is different?
No, of course it's different.
Yeah?
It's very different because large caps are well understood, well researched. The interactions are very different. The value of meeting management is far different. It's much more, you're just trying to figure out specific parts of the business as opposed to the aggregate business. The discovery is less, the volatility is less. The mishaps are lower, all of that stuff. So it's mid caps and small caps are themselves very similar, but mid and small versus large is very, very different.
Yeah. So
you also don't get the same brickbats, right? You won't get crucified if your Hindustan Lever call goes wrong, but you will if a small cap does go wrong.
Yeah. Between mid and small, what is the difference? Because I've just seen in general that the mid cap seem to perform better, at least more stable than small cap, which tend to be a little bit more volatile. Longer term returns are there for everyone to see. You look at 10-year returns, you look at 15-year returns, even 20-year returns. Mid cap somehow seem to be delivering that much better returns than the other two categories. Is that, does that say anything about the mid cap category as such?
That may be true as of now. We don't know what that answer will be, 10 years from now, right? Only time will tell who will play catch up and who won't. But the mid-cap universe now, as it stands now, if you go back 5-6 years ago, mid-caps were not tightly defined. It was individual mutual funds who determined what a mid-cap was. Now you have top 100, next 150, and the rest of the world. So today's definitions are very different, and large caps occupy roughly 2/3 of the market. So 65% is large cap, and roughly 17-18% each is small cap and mid-cap from a total market cap standpoint. So mid-cap is different because it's 150 companies occupying 17% of market cap, as opposed to 2,000 companies occupying the same 17% of market cap. So you can imagine the opportunities are far greater in small cap than in mid-cap in terms of number of businesses. Coverage is less, understanding is less, volatility is more, all of which are advantages.
What do you think, the chances for mid-cap becoming a large cap are more than the chances of a small becoming a mid? And where does the real beta lie there, to identify something and stick throughout the entire journey?
I'm not sure about that because, for a mid-cap to become into a large cap, you also need the large cap to become a mid-cap, right? To some extent. And there is limited maneuverability to get into that, 100,000 crore plus club. But I think the ability of 3,000 and 5,000 crore companies to become 10, 20, 30, 40,000 crore companies, that is far greater. So that's still it's all in the small cap universe. Because 30,000 is small cap and 5,000 is small cap, 1,000 is small cap. But inter small cap, there are a lot of changes. But I'm not sure whether mid moving into large is less or more than small moving into mid.
For the benefit of our audience, what is your process like? When you probably have filters, you have a lot of layers at which you choose which stocks to invest. What is that process like? And how has that changed in the last 20 years that you've been managing funds?
So our process is, we are very bottom up in the way in which we do things.
Yeah.
So we are stock specific, we are very long term in our orientation, which means our portfolio turnover tends to be quite low, typically 12-15%. We ideally would like buy into businesses which are sensibly priced, not just, we don't have to have them cheap, but sensibly priced, which means sometimes a little bit cheap, sometimes a little bit expensive, but nothing horrendously expensive, hopefully. We want to get into companies where management is honest and competent to the extent that we can ascertain that.
Yeah.
We want to buy into companies with decent cash flows. But none of this is unique, right? Every man, dog and his puppy has the same thought process. It's about discipline, right? Who's saying we're buying into poor quality businesses, churning aggressively and just doing what the hell we want? Nobody does that. Everybody's, I was in, this was a while back, but on stage where they asked 5 fund managers, what do you look for in a business? All 5 guys give the same answer, right? Which is exactly this. Nobody says I'm going to overpay and so on. But I think the key is to resist temptation, which is resist buying into cheap companies when they're poor quality and resist buying into super expensive companies when they're showing fantastic growth. You just got to resist the fringes as much as you can.
And how has that worked for you?
I mean, we've done okay, so I think it's, by and large, it's worked, but there are times when it's frustrating, right? Especially the stuff which is a little bit expensive or quite a bit expensive, and then you let it go, and then you just see it, keep compounding and getting higher and higher P multiples, and that's frustrating, but that's okay, that's part and parcel.
So when that happens, it's usually because of a couple of reasons. One could be just liquidity, which you can't fight against. The other is probably you got a call wrong either on the sector or on the management. Anything else there in that list?
I mean, perception changes, but you're right. I mean, obviously the growth delivers better, profitability improves or sustains for longer, and then becomes a fan following of some businesses, and then you can't shake the P, even if the business underperforms. And we've had businesses underperform for years at a time, and still held on to multiples which are, in my mind, difficult to believe.
And were you proven right?
I mean, I've been proven wrong many more times than I've been proven right.
How do you sleep then? At least in those times. Other than that, of course, you've been doing phenomenally well, but other than that?
Like I said, A, you put your hand on your heart, B, you realize that, investing is, a part of what we do. It is not who we are, right? So I think you combine that, and as long as you're doing the best that you can, you can't ask for much more from any individual. Do the best and be honest to your approach and thinking, and then you just have to wait.
What about stocks that have run away too far and you've realized that the story has changed, or as the saying goes, when the facts change, I change my mind? Does that happen often, or do you think that
we've missed out on a lot of stuff which we've never gotten into after that? It's
at all?
We have to, because some of these businesses, they become very expensive, and then the thought process is, let's hope and pray there's a shake, something goes wrong industry-wise, company-wise, country-wise, whatever, and then you get in, and it just doesn't happen. And then you just got to...
Which is, so, if there is one part of getting your winners right, and there's one part of avoiding mistakes. How do you differentiate between the two in terms of, your career so far? What is really the driver for beta, for performance, outperformance?
I'm not sure what the smart answer is, but I think in our case, a little bit of both, right? I think, very often people go for the right answer, smart answer, etc., etc. But I think it's, in most things in life, the middle path applies, right? Which is, it would have been great to avoid some of the big losers and great to catch some of the big winners. But both have certainly played a role. Without a doubt.
Yeah. And in both your schemes over the last, since it's been around, the bet has been on domestic cyclicals. If I look at your top holdings and sectoral allocation, banks, infra, industrial, has that really been the mainstay of the portfolio approach for both sectors?
You guys look at it much more, or I would say the analyst community and investor community looks at it much more from a sectoral standpoint. We are looking at it a lot more from a stock-specific standpoint.
Okay.
Within any given sector, there are many companies that we like and many that we don't like. Then we invest, we get a portfolio, and then we try and ensure that our allocation to a particular sector is not outrageously high or outrageously low. But at the end of the day, it is stock specific. But I'm not sure if it was domestic cyclicals only. We've had large holdings in pharma, large holdings in IT, large holding in capital goods, large holding in banks. We've not been present in commodities and metals, domestic and otherwise. So I think that's the only, or real estate. I think those are the two segments that we have not participated in. But otherwise, I don't think it's fair to say that we've been domestic cyclicals, because we've had lots of IT over the years, lots of pharma over the years.
So if I look at 2008 and 2018, 18 is when you're just probably at the bottom of the bear market in small and mid caps. 8 is when you're at the top. Were the approaches in the portfolio construction different in this 2018 cycle, which is still, I believe, is still in progress, versus what it was 15 years ago?
I don't know about 15 years ago, that's a long time. But no, our basic approach is, like I said, you want to aim for a portfolio ideally which has a PE multiple which is lower than the benchmark,
sure,
an ROE which is superior to the benchmark, a growth which is in line or better than the benchmark. And you do that by drilling down, getting stock specific, and giving up on liquidity, because nothing comes for free in life. So you give up on liquidity a little bit, you go drill down in terms of market cap, and you try and construct that portfolio, and hopefully that delivers over a period of time.
I guess one way of looking at it in a different way would be that handling the same scheme at 1,000 crore AUM versus handling it at 80,000 crore AUM. Is that,
I mean, obviously it is different, but I think this argument and discussion has been beaten to death with zero facts, interestingly. I mean, if life was this simple, you would just take the mid-cap category, small-cap category, sort by AUM, and you're off to the races, right? You just pick the smaller guys, avoid the larger guys, and you're done with. But that's not the case.
That's not the case
I can't
at all.
understand why this. We've been the largest mid-cap fund for at least 10 years.
Yeah.
And in those 10 years, we've had great performance, average performance, and terrible performance. And in all three environments, we were the largest. So if it was all about size, we'd only do badly or only do well, depending on whether we are large or small. The same thing applies to our peers, same thing applies to, so performance is a factor of being stock specific, getting your sector allocation right, what your style is, how lucky you are, and sure, size determines some constraints. But interestingly, small AUM funds are not small in their orientation.
Yeah.
We have the largest mid-cap fund with the second largest average market cap in our in the top 15 peers, or top 10 peers at least. So are we really small? I don't think you could pick up the fact sheet and determine that we are a large, we don't have a laundry list of stocks. Again, nothing wrong in having a laundry list at all. Again, this is one of those things where people who are concentrated talk poorly about those who are diversified. We don't. We think different strokes for different folks. But no, I don't think this is only about size. This is about many factors, and size is only one of them. And even within size, there are ways to manage it.
Yeah.
So when you put all of that together, there are so many things that work. I wouldn't just pick a small cap fund because it's small in AUM, or avoid one because it's large in AUM.
Yeah.
I think there are many other things at play.
Yeah, I think that's one thing that a lot of people kind of get wrong, that performance is related to size of AUM. So I don't think there's any data to back that claim at all.
It's just what we tell investors, right?
Yeah.
Because guys who are small saying, look at the guy who's big, he's too big, there's no way he's going to do well. And the guys who are, big, protect themselves by giving smart answers, like hopefully I've given. But it's not about that. I think we've got to recognize that different people have different approaches, and it cannot be, these are not simple answers. These are complex answers, right? And we're looking for simple solutions when the answers are genuinely much more complicated.
And that churn ratio, where do you get that number? I mean, it just optically it seems it actually is quite low if I compare it to the category average, or even in general. Because if you're talking about 10 to 12%, you're saying that you're actually staying invested in these companies, in these businesses, for a very long period of time. Has that been one of the pillars of your approach?
So, again, I think we try and appear smarter than we are.
It's not luck, I'm sure.
No, I think the smart answer is, that, we're 10-year investors and so on, which is part of the answer, that yes, we are long-term in orientation, and that's why our churn is, we're not the only long-term guys at all. But it's also the size does put a constraint on churn. If you're a 50,000 crore fund and you have a 15% churn, that's 7,500 crores of, buying and selling, which you're doing in a year, which is a lot. So I think when you have size, you become much more circumspect about the type of businesses that you own, because you're going to own them through tough times. You don't have the agility to get in and out. But to say that we are some legendary long-term investors, I don't think that is true. I think we are reasonably long in our orientation. Our size does put some constraint, and this is not a business which, it's okay to be lazy. I don't mean lazy that you don't do work, not that kind of lazy, but you have to hold businesses for a long time, and you have to, to think that I'll get out in tough times and get back in when the tough times get over and then get out again. That's very theoretical. Liquidity doesn't present itself.
Lazy and complacent are two different things.
Yeah, exactly.
Lazy, you could be complacent, you can't at all.
Yeah, I mean, Sanjay told me a long time ago that good fund managers should be spotted at matinee shows, right? We keep talking about, having punch cards and 20 investments in our life and 50 investments in our life, and yet our behavior is quite at contrast to that.
What about times when this is not held true, where you've kind of held on to the business, held on to the stock, probably believed in the management, and time just proves you wrong? That's happened?
Many times. It's gone to zero, right? We've had plenty of
zero.
Yeah, we've had companies which have gone to zero because of corporate governance issues.
Wow.
We've had industries like printing, which have just been massive disappointers. So when technology changes and stuff like this happens, and managements are not of good quality, and you hold, because the wisdom is that when the ship begins to sink, you jump, don't pray. But usually we do pray for a bit before we jump, and by the time we jump, it's most of the water is already in.
And if you look back into maybe the top 3 reasons of where things went wrong, what would they be? Like management or technology or anything else?
It's hard to pinpoint one thing, but I think, of course, management is a big part of it, right? And it's not about dishonest management. It's also about, and again, incompetent is a very strong word. People try hard, but different decisions don't work out. So of course, management has a big role to play in this. But very often, our understanding of the business is also a little bit more peripheral than it should be. I mean, it's not always easy to fully grasp a business as much as you ought to. So I think sometimes our understanding is wrong, sometimes the management is wrong, sometimes the industry goes through changes which you don't anticipate. So there are a variety of things which transpire.
And as per your own numbers, it's like 35% of the time you've underperformed. Getting things right 65% of the time is pretty good.
I mean, that's the model at least, right? That in a bear market, if we outperform, bull market we in a bear market we outperform, bull market we underperform, and rest of the times we outperform. That's I think a good way of looking at it.
I hope our audience can kind of get that, because that's precisely what they should also be doing, right? Because the numbers that you see on mutual fund churn, as in me as a retail investor holding on to my schemes and just churning them over and over again, that's not going to work, right? What's called the behavior gap, investor gap?
I think people have got it completely wrong, because this is all about longevity, right? That's the number one. The top 3 drivers of performance is asset allocation and longevity, or top 2. And this generation doesn't have it. They don't have that longevity. In every facet of their lives. This is the gig economy. People don't want to work for more than 5 years, right? People don't want to hold on to their investments for that long. People have tolerance for, I sound ancient, and I probably am by now.
Not as ancient as I am, but sure, please go ahead.
So, it's, when there's so much instant gratification in every aspect of your life, it's a bit unfair to then say in this particular aspect of your life, be really, really long term. This generation has not experienced it in most other aspects of their lives.
I don't get that, and I'll tell you why. Because, and especially HDFC Mutual Fund has the numbers. You got a scheme that started in what, 95? And how many of them are still there? I think the number is less than.
We've had many years, to be honest, we've not only had one year of underperformance.
No, I'm saying the number of original unit holders who invested when your scheme launched and have stayed till date in your scheme. I think Prudence is one which has been around for a long period of time.
Yeah.
And over 25 years, if you've got an investment in your portfolio that's giving you 18% or whatever the number is, it's more than index. What else could you ask for? Your financial goals would have been met. You just, people kind of extrapolate in their financial plan that 15% to ho jayega.
I think it's easy to say, invest for 20 years, invest for 15 years, it's easy to say, it's harder to implement. So you need, I think we got to recognize it's difficult. So you got to work hard to do nothing, right? You got to resist the temptation that, times are looking tough, environment is difficult, let me sell. And say, no, don't. Everybody's telling me to sell, don't. So that's not that easy. I think it's, it's very easy to give all this gyan that long-term investing and everybody should do it, but it's not as simple as it sounds. There's so many pulls and pressures, right? And that's what, your behavior goes against all the stuff which is good for you.
I just find it paradoxical enough that you hear so many people saying that if you had invested in the IPO of XYZ, you would be, ABC or whatever the number is. They go by a lot of the stories of individual investors who've taken very large. Basically, I'm saying that behavior works against you.
That's what I said.
Whereas if you were to do the same thing in a much, quote unquote safer instrument like a mutual fund and do nothing for 18 years, maybe review once in a while if you want, you'll probably achieve the same goals, the same results as that guy who.
Or probably better. Yeah.
Chirag, let's talk about these last 5 years. You've seen a lot of flows coming in, something that's probably not happened in the previous 20-25 years. A new generation has come in. You've got SIPs at 28,000 crores per month, which was, probably zero when you started your career 20-30 years ago. And now we're sitting at a position where the composition of equity AUMs shows that a predominance of sectoral thematic, small and mid cap versus large cap. Do you think that poses any risks for future performance from here?
It does to some extent, at least in shorter time frames, because mid caps and small caps are clearly more volatile. So you will have obviously large periods of outperformance, but you will have to also deal with periods of meaningful underperformance as well, right? And that's both relative and absolute. So that's bound to happen because that riskometer is there for a reason. It's not to be totally ignored, which unfortunately it is. But as you move from diversified to large cap and mid cap and small and thematic and so on, your risk profile increases, right? So you want that higher return. It comes at a cost. It comes at the cost of volatility. So you will go through periods of underperformance. But if you hold long enough, which is the trick in all of this, then you tend to do reasonably well.
You think the messaging, at least from the mutual fund industry, on investor behavior is making a difference? Or do you think this behavior will change because you've had a lot of SIP cancellations? You've got a lot of people holding on to their funds for a shorter period of time?
I don't think investors' fundamental thought process changes very substantially over a decade. I think it's an incremental change. People become a little bit smarter, sure. I think they realize that buy into tough times and so on, but it's all difficult to do. So we all know what to do, right? Buy in tough times and stay invested for long periods of time. But like I said, a lot of that stuff, as you alluded to, is not easy to do. So I think investor behavior changes unfortunately at a glacial pace. But I say unfortunate, but maybe it isn't, right? Because you need all types of investors for all types of other types of investors to make money, right? Sometimes you do need retail investors who have a short-term horizon. They have their role to play as well.
At least for the people watching this audience, for watching this episode, and in general, investor behavior should be slightly more longer term to really enjoy the returns, especially in a category like mid and small cap.
It should be, and I think the more you invest through institutional mechanisms, you tend to have a longer term perspective. I'm assuming, I don't know I don't have data to support it, but I'm assuming a young person who's investing in a mutual fund will tend to be more sticky than a young person investing in a stock. So I think the more you go from direct into mutual funds, you'll tend to invest for longer. But that's just a thought process. I'm not clear whether that's actually true or not.
Which is probably a good time to give your opinion to our audience of how they should manage their mid and small cap asset allocation within their overall portfolio. Any guidance on that? Any thoughts on that?
I don't have any specific numbers to anchor anybody. That you should have 30, 40, 80% in XYZ category. I don't have that answer because you have to tailor make that answer to the individual and their risk appetite and liquidity and profile and so on. But I think the simple logic is, when you're young, you have to go high on the risk scale. That's it. And when you're old, you go down on the risk scale. It's like, this is a very simple business. We don't have to overcomplicate it.
Yeah.
So when you're younger, but you have to have that ability to hold on, which again is not that easy or not that visible or prevalent. But if you're younger, otherwise, you should be, significantly overweight on small caps and mid caps as opposed to other categories, because you have that risk appetite. But the risk appetite has to be joined with an ability to hold on. If you have one without the other, it's pointless.
Yeah. How should they assess their holding? Like, how should they review it? It's one thing to say that, okay, I have an SIP in a mid and small cap fund and that's it, I'm done. For 10 years, I'm not even going to look at it. I'm not going to look, but it's easy to say, like you said, difficult to do. So is there a way
No,
of...
I don't think you should. I think there's nothing in life that you should not, fill and forget. You fill and you forget only if things work out, right? So you got to keep reassessing. I think if a fund chronically underperforms, then you need a sensible answer for that, as opposed to having a scapegoat. What is the reason for that, right? Is it something to do with the philosophy, something to do with the manager, something to do with whatever? But I think it's important to review reasonably regularly, but not to pull the trigger reasonably regularly. So you evaluate your funds on a constant basis, and then see, okay, there is underperformance. What's the reason? And does it make sense? Because nobody's going to outperform all the time. So as an example, if my funds are underperforming in a bull market, it's okay. You can understand that this guy tends to underperform in a bull market, so nothing to worry about. But somebody who is underperforming in a bull market and a bear market as well, then you wonder, right? So different people have different alpha capabilities, beta approaches, all of that stuff. But investors, distributors, everybody scratches the surface of analysis. Yeah. They don't know anything about their funds. They don't know what the PE is, ROE, growth, market cap distribution, sector allocation, will be there in the fact sheet, but they pretty much know what the fact sheet says. That's not even the surface. So we need to know. So if you have to analyze. Here, analyzing funds is analyzing performance. 1 year, 2 years, 3 years, 5 years, that's it, or 10 years, whatever it is. That's not analysis, right? That's, so I feel almost nobody analyzes funds. I've hardly met people in a 25-year career, how many people know the PE of my fund? How many know that how that PE changes the top 10, bottom 10 stock get removed? What is the liquidity constraints of the portfolio? How many stocks that we own more than 5% of the equity? How much, what is that churn? How has churn changed over a period of time? What is my ownership of the fund, right? So that's analysis, right? We do analysis of companies, and you have to take some of that into portfolios, but very few people do that.
You've in fact given me a laundry list. You just expand on that. Look at it in a different way. How should you choose a small and mid cap scheme? We spoke about how you should hold on to one, but how should you choose one?
I mean, you have to choose, you have to look at, many things, right? You look at what does the fund house stand for, what does the category obviously represent. You're saying specifically for mid and small, what is the individual manager's approach, right? It's not always easy to figure out that approach, because sometimes managers change, sometimes the individual's approach itself changes. But I think, if you do a little bit of work, one can figure out which funds do well in which environments, what is their approach, is it concentrated, is it diversified, is it value, is it growth, is it high P, low P, does it fluctuate, is it trading oriented, not trading oriented, and then you have diversity, right? I think this idea that my approach is the best approach is the wrong one, right? You've got to have guys who are operating well in certain market conditions and others who operate well in different market conditions, and that's diversity. Having 5 funds which do the same thing is, that's not diversifying.
Yeah, because I think, now when I look at it, the kind of performance that comes in bull market for small and mid cap embeds a certain expectation in the investor's mind that this is permanent. That small and mid caps will always outperform large caps, will always do well. They're giving me just, at some level, they're giving me a rate of return that will continue in the future, which history says that's not true.
No. In fact, in the US, mid cap, small cap, indices have performed. Now of course in the last 4-5 years everything has changed, but there's been zero difference between small cap and mid cap versus large cap indices. The difference is in the alpha, not in the benchmarks.
Oh, okay.
It's now of course that would have changed a lot, because in the last 4-5 years large caps have done extremely well. But so it's also about the alpha. It's not just getting the category right. The alpha potential in mid cap and in small cap is far greater.
Yeah, I think folks, we've got a nice list of factors to look at when you're choosing your mid and small cap theme. Chirag, where does this category go and grow in the future, right? Now you've already seen a pretty large, you launched in 2008, you're in 2024, that's 16 years. What do the next 20 years look like for this category? You think, for example, new sectors will come in that are more representative of India's economy? Do you think that, something would fundamentally change, or it's the same thing all over again?
I mean, we have difficulty what is going to happen 1 year from now. So to try and answer that 20 years from now, I think is a bit presumptuous. So I have no idea what is going to happen 20 years from now, and I don't want to. I don't think we need to expend energy on that. We got to figure out what's going to happen in the next 1, 2, 3, 4, 5 years, right? In terms of how businesses and sectors and so on. I mean, of course, it's important to have some perspective on the longer term, but I think we just have to. I'm fairly old-fashioned in that way. The more things change, the less they do. So I'm more on that school of thought.
Yeah. How about companies where traditional valuation parameters or benchmarks or ways of DCF, for example, just doesn't work? Because that's what the sector is about. That's what, that's probably a post-GFC thing that has come in the market, that you've got businesses that don't really make profits for a long period of time, but trade at some insane valuations. How do you make sense of that? Because some of these enter in as small and mid caps and then, become much.
I think you've got to choose which game you want to play, right? A lot of these businesses do fantastically, right? Which don't make profits for years and years and years and years at a time, and then just go absolutely crazy. And of course, some of them collapse. But it depends on what you're good at. You cannot be the master of all. It's not possible. You can't be, I'm going to invest in concept stocks, I'm going to invest in late stage, early stage, this stage, that stage. Public market investors will be terrible private market investors. And I don't mean private as in unlisted companies, but as in early stage companies, because the whole skill set is very different. So it's not easy to pick companies where, for guys like me especially, who are a little bit more value conscious. And I don't think you have to try and reinvent the wheel. You say that, what? I won't make money in this space because it's harder. I'll make money later on. I'll give up the first big sort of gap in returns, and I'll participate later, right? Because I'm not sure whether I have that skill set. I'll identify some winners for sure, but I think they'll be accompanied with enough of losers to take away from that.
And in a fund manager's mindset, sitting it out, is it difficult?
Sitting it out? Yeah, of course it's difficult, right? You see everybody making money and things going crazy, and you feel stupid, you feel envy, you feel all of that stuff, right? We are all very, very human in that way. So of course it's not easy to sit it out, but for some of us, for some people it's a little harder, some people it's a little bit difficult, and at times, right? So if you miss out when your fund is still doing okay, then you're still fine. When you're missing out when the fund is really doing badly, then it's obviously more challenging. So it's not easy.
You're looking at a bunch of investors who, when they look at their portfolio and they look at some schemes that are not doing well, they also feel that fear of missing out. It seems to be much stronger than making money in the bull market. It kind of probably is behavioral finance at play, because loss aversion, regret are very powerful things.
Sure, of course, absolutely.
So if there's something that our audience can absorb or learn from the fact that when some schemes are not doing well in a portfolio, you have to take that time out.
In fact, I feel it's even more than that. I think when some schemes are not doing well in your portfolio, you have to ask yourself, the first question and the second and the third question is, should I get out? When should I get out? Why should I not get out? As opposed to, why is nobody thinking, should I double down? Right? How many times have we seen managers do badly to come back fairly strong after that? And if this is not only catching stocks in underperforming years, it is also partly about catching mutual funds in their underperforming years. And we've had plenty of managers, including myself, who had very rough patches. And now, do you want to abandon them in those times? It's easier to abandon. Or do you double down? That's far harder. But it tends to be a little bit more rewarding.
How have you taken out the rough patches? What are the lessons you've learned? What kind of, has made you, has pulled you ahead? And it's obviously done a very good job, because again, your performance shows.
Like I said a few times earlier, you're going to have, you don't have to get carried away with any kind of patch. When you're in a sweet spot, don't get carried away and think you're too smart. When you're in a rough patch, don't think you're damn dumb. You've got to be balanced. You realize that, everything normalizes in life, right? The good times will eventually lead to more tougher times, and the tougher times will also eventually lead to better times. So don't get carried away, work hard, do your best, put your hand on your heart, and that's it.
make it sound simpler than it actually is.
It is that simple. It's not simpler than it actually is. As simple as that. We complicate it.
Yeah. And what has helped you in the process? I mean, do you find solace in, I don't know, travel, books, music, anything, or are you more of a...
All that stuff is cliche, right? I mean, all the answers, you know, I love to spend time with my family and my friends and, you know, eat out food and all that stuff, right? You know, unfortunately, this country doesn't afford us the ability to pursue really eclectic interests. So, you know, everybody's interest is a list of one of 7 items.
And which are the list of your, what's one of your 7
All those that I just mentioned.
Okay, last question. Your advice to someone starting his or her career, you know, let's say in a mutual fund as large as yours, what would you tell this person, you know, who's pretty sure that he or she wants to make it in fund management?
You know, my advice is not, it's the same as the advice I got when I started, right?
Which was?
Just, you know, don't be afraid of mistakes, work hard, know yourself, be honest to yourself, have that intellectual honesty, and, you know, just put in the work and be disciplined and know where your weaknesses are as best as you can, and just keep at it.
Work like Chirag did under Sanjay and Prashant?
No, I was fortunate, you know, unfortunately this generation doesn't get the kind of upbringing that I got. You know, I got to learn under Sanjay and Prashant, so then, you know, it has to rub off, right? Young people don't get, unfortunately, that the ability to work with such smart people.
In their defense, they said, we've got social media. We've got 5 tips on how to be
I'm not sure if that's a defense, but...
Both of us belong to a certain generation who knows that, you know, I think they call it the school of hard knocks or something. That probably makes sense, right?
Sure.
On that note of valuable career advice and how to manage your portfolios, that is a wrap on this episode. My guest, Chirag Setalvad, Fund Manager and Head of Equities at HDFC AMC Limited. Chirag, thank you so much.
Thank you. My pleasure entirely.
Thank you.